Something just changed in XRP that matters more than it looks. A key U.S. crypto bill appears to be closer to completion than at any point since negotiations began, potentially reducing one of the biggest sources of uncertainty for institutional investors. At the same time, XRP is showing a market structure that traders have been watching for months. In this video, we'll examine what credible insiders are saying about the Clarity Act, why the remaining legislative hurdles may matter, how XRP's current technical structure fits into the bigger picture, and why the distinction between short-term price action and long-term financial infrastructure could be the most important takeaway. According to Coinbase's vice chairman, the Clarity Act is now at what he described as the half-yard line, with most major disagreements already resolved and only a limited number of issues still being negotiated. That's a meaningful shift because markets don't wait for legislation to become law. They begin repricing assets as uncertainty starts to disappear. At the same time, Senator Cynthia Lummis has publicly expressed frustration over delays, arguing that the need for clear digital asset legislation has become increasingly urgent. Those two developments together tell an important story that is no longer about whether crypto regulation is coming. It's about how close the market may be to receiving a framework that institutions have been waiting for. For XRP, that timing is particularly interesting because its current technical structure and the broader regulatory landscapes are beginning to converge in ways that many investors believe deserve close attention. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Earlier in the legislative process, the proposal contained hundreds of pages. Numerous regulatory agencies were debating jurisdiction. Questions remained over whether certain digital assets should fall under SEC oversight or CFTC supervision. Consumer protection language continued evolving. Stablecoin provisions generated debate. Ethics concerns emerged. Political disagreements slowed progress. In other words, the bill wasn't simply unfinished. It was structurally incomplete. Today, that picture appears dramatically different. Most of these issues have reportedly been resolved through bipartisan negotiations. The remaining debate centers largely around one ethics grandfather clause. And while that may sound insignificant, history repeatedly shows that major legislation often spends the longest amount of time resolving its smallest remaining disagreements. Because once broad consensus exists, attention shifts towards details. Now, this is what most people miss. Markets don't simply react to legislation. Markets react to certainty. Investors price probabilities long before official announcements arrive. Sometimes the expectation becomes almost as powerful as the event itself. If institutions begin believing regulatory clarity is approaching, preparation often begins before votes are finalized. Legal teams begin reviewing frameworks. Compliance departments update policies. Banks evaluate products. Custodians prepare infrastructure. Investment committees revisit previous decisions. The market rarely waits until everything is officially complete. It starts adjusting as uncertainty begins disappearing. That's an important distinction because uncertainty carries a cost, and removing uncertainty often unlocks entirely new categories of participation. Senator Cynthia Lummis recently expressed frustration over legislative delays. Her criticism reflected something increasingly common among policymakers, the realization that digital assets are no longer a niche technology discussion. They're becoming part of a broader financial infrastructure around the world. Governments aren't asking whether tokenization will happen. Many are asking how quickly it can be implemented. Central banks continue researching digital currencies. Commercial banks continue experimenting with blockchain settlement. Asset managers continue tokenizing financial products. Payment companies continue modernizing cross-border settlements. The conversation has shifted. Less debate over existence, more debate over implementation. And that's a profound structural change. But here's where it gets interesting. This isn't happening only inside the United States. Globally, financial infrastructure is changing at an accelerating pace. Japan continues advancing digital asset initiatives. Stablecoin frameworks continue developing. Major financial institutions are exploring tokenized deposits. Cross-border settlement pilots continue expanding. Organizations responsible for enormous volumes of financial transactions are testing blockchain-based efficiencies. The reason is straightforward. Traditional finance infrastructure wasn't built for a world that never sleeps. Digital assets operate 24 hours a day, 7 days a week. Settlement can occur dramatically faster. Transparency improves. Automation expands. Operational costs may decline. These aren't ideological arguments. They're operational considerations. And institutions tend to adopt technologies that improve operational efficiency. History offers an interesting perspective here. During the Industrial Revolution, railroads dramatically changed commerce. Before national railway networks connected major cities, businesses relied on fragmented transportation systems. Trade was slower, more expensive, less predictable. Once standardized railway infrastructure expanded, entirely new industries emerged. Manufacturing accelerated. Supply chains transformed. National markets became possible. The tracks themselves weren't the economy. They became the infrastructure supporting economic expansion. Many analysts see blockchain technology through a similar lens, not necessarily replacing finance, modernizing the rails beneath it. Whether every blockchain succeeds is another question entirely, but the broader infrastructure transition appears increasingly difficult to ignore. This brings us directly back to XRP. One of the reasons XRP continues attracting attention is its long-standing focus on payment settlement. Unlike many speculative digital assets that primarily emphasize decentralized applications or consumer ecosystems, XRP has consistently maintained a narrative centered around financial infrastructure, cross-border transfers, liquidity, settlement efficiency, institutional integration. That doesn't automatically guarantee future adoption, but it does explain why regulatory developments carry particular importance. Financial institutions generally require legal certainty before integrating settlement technologies into critical infrastructure. Regulation and utility often evolve together. One without the other creates friction. Meanwhile, technical analysts are observing another development. Many believe XRP has entered what resembles the later stages of Wyckoff accumulation structure. For viewers unfamiliar with Wyckoff methodology, the concept is relatively straightforward. Markets often experience long periods where stronger participants gradually accumulate positions while price appears relatively stagnant. During these phases, public interest frequently declines, volatility compresses, sentiment weakens, yet beneath the surface, ownership slowly changes hands. If accumulation eventually completes, price can sometimes transition to significantly stronger upward trends. It's important to remember, technical analysis isn't certainty, it's a probability. Patterns fail, markets surprise participants. But many experienced traders continue watching these structures because similar formations have preceded major market moves in the past. Some analysts now describe two possible pathways for XRP if regulatory clarity continues to improve. The first is narrative-driven. Imagine legislation advancing successfully. Financial media begins covering regulatory certainty. Institutional participation becomes a dominant discussion. Retail enthusiasm returns. Momentum traders enter. Algorithms respond to increased volume. The result could be a rapid repricing driven primarily by sentiment. Markets often move fastest when perception changes, not fundamentals necessarily. That would represent the short-term scenario many traders are discussing. But price reacting is different from systems evolving. And that distinction leads directly into the second pathway. See, ladies and gentlemen, the long-term thesis depends far less on headlines. Instead, it depends on infrastructure. If platforms like Ripple Prime continue expanding institutional services, if tokenized assets continue growing, if lending platforms such as Evernorth mature, if settlement infrastructure across financial markets increasingly incorporate blockchain technology, demand would become linked less to speculation and more to economic activity. That's a fundamentally different investment framework. Speculative demand often arrives quickly. Utility-driven demand develops gradually. But historically, utility tends to be more durable. And that's precisely why institutional investors spend so much time evaluating infrastructure rather than daily price action. Because short-term noise captures headlines, long-term structure creates markets. But before anyone assumes the path forward will be perfectly smooth, it's worth remembering another chapter in XRP's history. During the SEC lawsuit, many investors believed the project's future had been permanently damaged. Fear dominated sentiment. Exchanges suspended trading in some jurisdictions. Uncertainty reached extraordinary levels. Yet despite those challenges, XRP eventually experienced a remarkable recovery as markets reassessed the long-term picture. That episode served as an important reminder. Markets frequently overshoot in both directions. Fear can become excessive. Optimism can become excessive. The challenge for investors is distinguishing temporary narratives from structural developments. Because while prices react to headlines, financial systems evolve over years. And right now, many investors believe the regulatory foundation for the next phase may finally be approaching. But here's where the two conversations become even more important. Regulatory clarity by itself does not create value. It creates the conditions for value to be discovered. That's an important distinction because markets often confuse the catalyst with the outcome. A law can remove uncertainty. It can encourage participation. It can define responsibilities between regulators. But what ultimately sustains a financial asset over years is whether it solves meaningful problems inside the financial system. This is why the discussion surrounding XRP has increasingly shifted away from simply asking, will the price go up? Instead, institutional investors are asking a different question. Where could XRP fit inside the evolving architecture of global finance? That is a much bigger conversation because financial infrastructure changes slowly. But once those changes occur, they often remain in place for decades. Now, this is what most people miss. Markets frequently reward companies and assets long before the majority recognizes structural transition. Consider how institutional capital behaves. Large asset managers don't simply wake up one morning and decide to allocate billions of dollars. There are committees, risk assessments, legal reviews, compliance procedures, custody evaluations, operational testing, stress scenarios. Every major allocation typically moves through months, sometimes years of preparation. That's why regulatory certainty matters so much. It reduces unknown variables. And for institutions, reducing uncertainty is often more valuable than chasing the highest possible return. Predictability attracts capital. Chaos usually repels it. One of the most significant implications of comprehensive digital asset legislation is the possibility of expanding participation beyond today's crypto native investors. As regulatory framework becomes clearer, more traditional financial products could eventually incorporate digital assets where appropriate. Investment managers could evaluate new strategies. Banks could explore additional custody and settlement services. Financial advisors may gain greater confidence discussing digital assets with clients. Retirement portfolios could, where regulation investment mandates permit, gain broader access to regulated investment vehicles. None of this would happen overnight, nor is every institution guaranteed to participate. But history shows that when regulatory frameworks mature, participation often broadens. Markets become deeper, liquidity improves, price discovery becomes more efficient, and institutional involvement tends to stabilize ecosystems over the long run. That brings us to another area receiving increased attention: tokenization. Around the world, financial institutions are exploring ways to represent traditional assets digitally on blockchain infrastructure: stocks, bonds, money market funds, treasury securities, real estate, private credit. The appeal is straightforward. Digital representation could simplify settlement, reduce administrative complexity, increase transparency, potentially improve liquidity for certain asset classes. Many of these initiatives remain in their early stages. Some may succeed, others may not, but the direction of travel has become increasingly clear. The financial industry isn't simply experimenting with digital assets anymore. It's experimenting with rebuilding financial infrastructure itself, and that represents a much larger opportunity than speculative trading alone. History provides another fascinating lesson. In 1913, the creation of the Federal Reserve fundamentally reshaped the American financial system. The immediate impact wasn't a dramatic overnight transformation. Banks didn't suddenly operate differently the next morning. Instead, a new institutional framework gradually emerged. Over time, monetary policy became more coordinated. Financial stability mechanisms evolved. Markets adapted. The significance of that change became clear with each passing decade. The lesson isn't that blockchain resembles central banking. They're fundamentally different. The lesson is that lasting financial transformations can often begin with changes in the rules governing the system. Regulatory architecture frequently precedes market architecture. This is why some analysts distinguish between the two entirely different valuation discussions surrounding XRP. The first concerns market psychology. If regulatory clarity arrives, enthusiasm alone could produce substantial volatility. We've seen this throughout financial history. Markets often move rapidly when uncertainty disappears. Momentum builds. Narratives spread. Trading accelerates activity. That would represent a sentiment-driven phase, potentially powerful, potentially fast, but also inherently emotional. The second discussion is considerably more complex. It focuses on actual network usage, settlement activity, liquidity demand, institutional participation, financial applications. Those drivers develop more gradually, but they also tend to produce more sustainable foundations if adoption continues expanding. One is primarily driven by expectations, the other by economic activity. Understanding the difference helps investors separate excitement from long-term structural analysis. But here's where it gets very interesting. Ripple has continued expanding enterprise-focused initiatives despite years of regulatory uncertainty. Rather than waiting for perfect conditions, the company continued building relationships with financial institutions, payment providers, and infrastructure partners in multiple jurisdictions. The persistence matters because technological adoption rarely follows a straight line. Companies often spend years building infrastructure before broader markets fully appreciate its significance. If regulatory clarity removes one of the largest remaining barriers in the United States, investors will naturally begin asking whether those years of preparation could translate into faster commercial adoption. That remains an open question, but it's one institutions are increasingly evaluating. At the same time, projects like Evernorth illustrates another trend emerging across blockchain ecosystems: increasingly speculation. The earliest years of cryptocurrency focus heavily on simple transfers of value. Today's ecosystem looks very different. Developers are exploring lending, tokenized assets, smart contract execution, institutional financial products, compliance solutions, identity frameworks, enterprise integrations. As digital asset ecosystems mature, the conversation shifts away from individual tokens and towards complete financial networks. Infrastructure becomes more important than hype. Utility becomes more important than slogans. That's a natural evolution of any emerging technology. Imagine the construction of an ancient Roman road. At first, it looked little more than a carefully placed stones. Expensive, time-consuming, easy for critics to dismiss. But once completed, those roads connected cities, accelerated commerce, improved communication, and supported an expanding economic system for centuries. Blockchain infrastructure may follow a similar pattern. The individual pieces often appear disconnected while they're being built. Only later does the broader network become visible. Again, it's an analogy, not a prediction, but it highlights how infrastructure investments often reveal their full value only after the network matures. This also explains why technical analysis and fundamental analysis sometimes appears to tell different stories. Technical traders focus on probabilities, patterns, momentum, volume, support, and resistance. Fundamental investors concentrate on adoption, revenue opportunities, institutional partnerships, regulatory developments. Both perspectives can be valuable, but they answer different questions. Technical analysis asks what the market may do next. Fundamental analysis asks why the market may eventually stay in a particular direction. When both narratives begin pointing in the same direction, investors often pay closer attention. That doesn't eliminate risk. It simply strengthens the overall investment discussion. Of course, no market moves in a straight line. Even during powerful bull markets, corrections are normal. Unexpected legislation creates volatility. Macroeconomic events can temporarily overwhelm sector-specific news. Central bank policy continues to influence liquidity across all financial markets. Interest rates matter. Credit conditions matter. Global risk appetite matters. Crypto does not exist in isolation. It exists within the broader financial system. That's why experienced investors rarely focus on a single headline. Instead, they monitor the interaction between macroeconomics, regulation, institutional adoption, and market psychology. Those forces together shape long-term outcomes. Think of the early days of the internet. In the beginning, many people focused almost entirely on individual websites. Over time, it became clear that the greater transformation wasn't any single website. It was the network connecting them all. Digital assets could evolve in a similar way. While today's discussions often center on individual cryptocurrencies, the larger story may ultimately be the financial network emerging beneath them. In that scenario, infrastructure providers, settlement layers, and interoperability became increasingly important. The value shifts from isolated applications to connected systems. Again, this is an analogy rather than a forecast, but illustrates why many institutional analysts spend more time studying networks than headlines. So where does all of this leave XRP today? The answer depends on the time frame. In the near term, markets are watching Washington. Investors are evaluating reports that negotiations surrounding the Clarity Act have narrowed to a small number of remaining issues. They are listening closely to comments from industry leaders who believe bipartisan cooperation remains intact. They are assessing whether regulatory uncertainty is finally approaching an inflection point. In the medium term, attention turns towards implementation. Will institutions expand participation? Will tokenization continue accelerating? Will blockchain settlement become more deeply integrated into financial markets? Those questions cannot be answered in a single week or a single month. They unfold over years. And in the long term, the biggest question may not be whether XRP experiences periods of volatility. Every financial asset does. The more important question is whether the broader financial system increasingly values the role that digital asset infrastructure can play in a faster, more interconnected global economy. That is the structural debate now taking place. Prices react and the systems evolving. Those are not always the same thing, but occasionally they begin moving in the same direction. And when they do, markets tend to pay very close attention. If the Clarity Act becomes law, it won't simply represent another legislative headline. It could mark another important chapter in the maturation of digital asset regulation in the United States. Whether that leads to the bullish scenario some analysts anticipate remains uncertain. Markets always retain risk. Adoption always takes time, and expectations can sometimes move ahead of reality. But one thing is becoming increasingly difficult to ignore. The conversation has evolved. The debate is no longer whether digital assets are a replace in modern finance. The debate is increasingly focused on how they will be integrated into it. For XRP and for broader digital asset industry, that may prove to be the most important shift of all. If you enjoyed this deep dive and want more institutional level analysis covering macroeconomics, regulation, blockchain infrastructure, and the forces shaping the future of global finance, be sure to subscribe, leave a like, and share your thoughts in the comments below. What role do you think regulatory clarity will play in the next phase of digital adoption? Thanks for watching, and I'll see you in the next video. Hope everyone's having a blessed Saturday. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. The market right now is being driven solely by fear. Fear of disappointment and fear of inflation. Whenever the market gives us a narrative where its price action is going to be driven by something, it allows us to find alpha. Right now, as risk off is on, it's value shopping for any risk type asset. Cryptos, most importantly. This narrative will end at some point, and we'll see real action. If you look at the issues right now in the world, the two ones that we spend most of our time talking to the people that retain a capacity, the ever-growing war, it's expanding, and the 30-year. To us, those tell the biggest story. The rest of the summer until Labor Day is probably going to be keyed off of the military responses that POTUS gives to Iran. That's where that's looking to become increasingly. But at some point, the market will price all of these things in. And once that happens, the true bottom comes. My own opinion about everything is different than what most people think. I'm a financial mercenary. Our livelihood depends on being correct for the family office and families and sovereigns that retain us, not for making videos or content. They're two very big different things. When you look at the world, the argument and the fragmentation that's begun over commodities will continue. We believe every metal will become a critical metal and be put on a list at some point. We also believe that the argument over rare earth metals is going to heat up in a much bigger way than most people are paying attention to. The same way that we get phone calls from our refineries every day in Indonesia from customers looking for any sulfuric acid that we can sell. It's a byproduct of refining. But I look at it like this, plain and simple. XRP is going to face downside pressure. Everything's going to face downside pressure right now. Never trade with leverage. That's how you get cut up like sushi, ladies and gentlemen. Everything is to the downside right now, structurally, charts, even from a narrative. There's no reason to be optimistic right now in the short term. Be optimistic that you're getting a chance to get things at a discount. That's very important right now. Ladies and gentlemen, if you want to learn to trade, if you want to learn to invest, come and join the Crypto Public Desk Monthly and join over 630 active traders and investors who are learning how to take advantage of the volatility that's coming and it's happening right now to be able to add to the bags of cryptos that they want to add to. There's no reason why you can't benefit from the man-made chaos that is probably really, really stupid as far as we're concerned. But again, once the risk and the fear leave, the risk, do banks get it wrong? Because banks can't afford to be wrong. If they get it wrong, they lose customers. The market's going to have a rip your face off rally. Right now, the people that borrow money to invest for AI, they use the 30-year. If that keeps going up, they will not be able to borrow money to do this. They're also issuing more stocks instead of buying their stocks back. This is an AI war. We were first telling you here, long-term viewers of this point in this channel, it's a kilowatt war, which it was. The whole world is being rewired right now. It pays to be patient. It pays not to get cut up like sushi. It pays to learn how to take advantage of every other asset class. Because people sit here and they talk about, one, you'll miss this, you'll miss that, blah, 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 blah. The price action's this, the price action's that. I'll be dead before this, I'll be dead before that. Ladies and gentlemen, investing is an occupation. Trading is an occupation. It's the oldest wealth creation system there is. I remember taking my Series 3, the Butter and Cheese Exchange. That's what the New York Mercantile Exchange, now the CME, was called. The Butter and Cheese Exchange. It was designed for hedging. Hedging. That's why in the futures, every third week, you got to roll your position or take delivery. I remember on the floor, people getting things delivered to their houses. I mean, at first I thought that they were crazy, but at 15 years old, when someone has things delivered to their house because they didn't offset their position, it's quite hysterical. But when you have to be accountable for what you say, it's a different story. The price action right now in markets is spectacular. It's spectacular. It really is. I mean, this is not to me better than when crude oil was basically zero. We were finding any place that we could basically store it. We haven't gotten to that extent, right? But the cryptos are getting to a point where we believe there'll be a V shape. There's going to be a flush out, and we're going to see some damage. We're going to see some horrific damage coming, right? But at the same point in time, if you're prepared for the damage that's coming, you can take advantage of the discounts that are there. Because everybody says at some point you would have missed the boat, this, that, blah, blah, blah. I'm not in that camp because price actions will move up and down always and everything. You use financial instruments to make alpha to accumulate things that make sense to you. But the plays in gold and silver, rare earths, oh my God, food. There's a food crisis no one's paying attention to. Corn, wheat. But then again, these things are boring. But to financial mercenaries, this is how we make money off of this. I love the haters. I love the hater comments. This is great. No, I am not an AI person. I edit videos. No. But you know something? Ask yourself this. If you had the chance to buy more of your favorite cryptos, XRP, ICP, at rock bottom prices, would you take that? Or would you sit there and complain that the market gave you those prices? Pigs get slaughtered, hogs get fatter, ladies and gentlemen. None of this is financial advice. This is just my own opinion. Everything is at a capacity. These videos are for educational, informational purposes only. They're not financial advice. Consult your licensed financial advisor always. Never invest any capital based on watching a YouTube video. Again, never, ever invest any money from watching a YouTube video. Don't ever do that. But ask yourself this, and this is a big question. If you're given the price points to enter that you were wishing for a year or two ago, would you curse the market because it went down, or would you take advantage of that? When you have a plan of what you're going to do in the future, that's the most important thing. But long after this time frame is over and we looking at these videos age, trading will still be very important. Investing will still be very important. Being able to isolate winners in the equities market, the futures market, will be extremely important, because after you create your windfall from your solid investing and getting in early with that Gucci conviction, that Gucci clarity, and you're walking up that long frosty mountain now, and you're mapping out your destiny with your family, you're going to need to know how to manage what you have. Because as everyone says, AI can do this, AI can do that. We get phone calls every day in our offices to companies wanting to train their AIs off of us. We laugh at them. I have to laugh because AI cannot do what a human being can do. There's judgment calls that it just cannot do until it has more integration. But we're not going to see that for a very long time. I'm sorry. Humans will be viable. Creativity, learning how to spot something is more important than what a computer can do. I'm sorry. Computers are built by men. That's what they do. They're programmed. How do you program something for profit? How can you program something to take advantage of events when it doesn't know what events can cause or not? It's only going to know what those events can cause or not by the person that programmed it and their views and their takes. So unless their views and takes on things are that of a financial mercenary, a mindset that is like Switzerland or Singapore, it's just about making alpha, good luck to you. Again, stay strong. Keep that Gucci conviction, that Gucci clarity. Don't pay attention to the naysayers. Ladies and gentlemen, if you want to learn to trade and invest, come and join the Crypto Public Desk Monthly and join over 630 active trading investors who are taking their destiny into their own hands. But again, I love the haters. I love you all. I'll see you in the comment sections, and I'll see you on the front lines, ladies and gentlemen. Love you all.